Let's talk now about the Fed's aggressive action with George Noceti, Morgan Stanley wealth advisor. Thank you so much, George, for being here tonight. The Fed signaled that more rate hikes could be ahead. What do you anticipate the rest of this year and into 2023?
Heather, the Federal Reserve put the hammer down on raising the rates. This is the third rate this year at 75 basis points. It's the most aggressive the Fed has ever been in terms of these quick, close together rate increases. And we're expecting one next month. There's a 75% chance it'll be another 75 basis points. Federal Reserve wants to get ahead of this inflation curve, wants to get it over with fast. And by doing that, they're doubling down on the rates, which are affecting all parts of the economy. Not right now, but eventually they're going to all, click in the next several months when it matriculates through the system. So by the end of the year, we expect the lending rate to go up to 4.4%. And next year, we don't expect it to go down. It'll probably be about 4.6%. And then at the year after that, in 2024, probably down to 3.9. And then we might get down to the 2% level. This inflation is really integrated in the economy because we are, flush with cash. And we have a lot of money chasing too many products, or too few products, rather.
George, do you think that these continued substantial rate hikes, one after another, and sort of no end in sight here, does this lessen the likelihood that the Fed is going to be able to achieve what we have talked about here, that so-called soft landing? Do you see that as being less and less likely?
Well, all bets are off on this. I mean, this is a $25 trillion economy. I mean, it is mega huge, biggest economy in the world. We stopped it on a dime with COVID, and then we flooded it with money so we wouldn't land in a depression. And now we have to get out of this inflation issue. So it's really hard to say whether it's going to be a soft landing. But the Federal Reserve, let's be clear on this, is very, very strong on one hand inflation, and they'll keep doubling down on the rates until they do that. Now, there'll be a lot of pain costs. There'll be a lot of effects. I mean, you've seen what the housing market has done. Tuesday, the new housing starts report came out. It was up slightly because interest rates were down in July. But trust me, new construction is really on hold right now. Permits are expensive, materials are expensive, labor's hard to find, and the interest rates are coming in at a median of about 6.2%. So, the housing market is going to be very, very slow for a while until we can get these rates down. So that's why they're hustling to get this done.
Yeah, George, let's talk quickly about the unemployment rate. Fed expects it to inch up a little bit. Which sections of the workforce do we expect to bear the brunt of these layoffs?
Well, first of all, Heather, the unemployment rate is incredibly low. Okay. And if there are layoffs, yes, it'll raise the unemployment rate up to maybe 4%. But there's still 11 million more jobs that have to be filled. So it'll be kind of a push. They don't want to destroy the employment numbers because they do want to keep people working, but they have to have some people laid off in order to stop and slow spending down. So, we think this is going to be a trend in terms of employment. But again, we still have a lot of jobs to fill. The economy has just been so strong with incredible savings that people have and most people working. And so that trend's going to continue really for quite a while.
Yeah, no end in sight here to these substantial rate hikes, at least for the near future. We appreciate the insight tonight. George Noceti, Morgan Stanley wealth advisor. Thank you for coming on.
Thanks a lot.
All right.